You've carefully charted the resistance lines, perfectly timed the entry, and you execute the long position on gold. You place a tight stop loss, assuming a manageable, fractional drop in your account. You're thinking in standard currency rules, where a price movement is a microscopic 0.0001, so the financial risk feels contained. But gold is volatile. A sudden market reversal hits, and your screen flashes red as the trade strikes that stop loss. The platform closed the position exactly where you asked. But when you check your account balance, the cash pulled from your margin is significantly larger than you budgeted for. The math failed because you traded XAUUSD like a currency pair. Traditional forex pairs measure price movements in standardized, uniform units, but the gold market ignores that baseline system. Taking standard forex logic into the gold market leads to consistent miscalculation. Without knowing exactly how the platform prices a fraction of an ounce, you are risking capital without a clear view of your exposure. To figure out your real exposure, we first have to define what a pip actually is in gold trading. It is nothing more than the smallest price increment your specific broker chooses to display on their platform. That brings us to our first moving variable, decimal precision. There is no universal standard for how a broker quotes the price of gold. A 1 decimal quote means the smallest move is 10 cents. A 2 decimal quote is 1 cent. Variable 2 is contract size, the gold volume controlled, split into standard lots of 100 ounces, many lots of 10, or micro lots of 1. Your broker's precision and your contract size operate entirely independently of each other. That creates a matrix of possible pricing structures, depending entirely on which firm holds your account. Because both of these factors shift depending on where you trade, your projected profit and loss is just a guess until you verify the specific contract size and decimal layout used by your broker. Fortunately, there is a single, reliable equation that cuts through the broker variations and pinpoints your true financial exposure. Pip value equals contract size times smallest price increment. Using a standard 100-ounce lot and 2 decimal quote, multiply 100 ounces by 1 cent. Your pip value is $1. A $5 price rise means 500 pips. Multiplied by your $1 pip value, you net a $500 return. You can scale this math quickly in your head. For a mini lot holding only 10 ounces of gold, that exact same $5 price move yields just a $50 return. Internalizing this exact mathematical sequence removes the guesswork from your strategy. You gain the ability to forecast precise dollar outcomes before you ever expose your capital to the market. Calculating potential profit is useful, but this math is even more effective when used in reverse to engineer your trades and strictly cap your downside. Imagine you follow a strict 2% risk rule, capping your maximum allowable loss at $200. Your technical analysis dictates a stop-loss distance of 400 pips. This chart breaks down the reverse calculation. You take your $200 maximum risk, divide it by the $400 exposure of a standard lot, and the resulting math dictates a required position size of exactly 0.50 lots. Instead of adjusting your trade size after entering the market, this calculation ensures your position is calibrated to your specific dollar risk before the trade is ever placed. Your immediate next step is to open the specification window on your broker's platform. Verify your exact contract size and decimal layout right now. When the market is moving fast, you can automate this entire process using the FXNX Gold Pip Value calculator to ensure accurate math under pressure. Gold's volatility doesn't leave room for the standard assumptions used in Forex. By applying these specific calculations, you replace unexpected account shocks with precise, pre-planned risk control.